Hey, what's up, everybody? It's Jamel Gibbs, your family oriented entrepreneur. Welcome to another podcast episode. This is the Business and Investing Podcast, where you learn all things business and investing related. So, today we're going to talk to a specialist, a HELOC specialist. HELOCs have been a key topic on this particular channel, on my podcast as well. You know, I've had recent guests, DeAndre Clayton, as well as Reggie Briscoe talked about it. And today we're going to have someone that DeAndre introduced me to. His name is Anthony Rushing from FirstLienHELOC.com. We're going to talk about how people are using first lien HELOCs to pay off their mortgage within the first 5 to 7 years of having that HELOC on their property. So how can you pay off a house within 5 to 7 years? On a previous episode, you heard Reggie Briscoe talk about how he did it within 3 years, right? So I'm going to talk to Anthony Rushing today. We're going to talk about exactly that. How is it even possible? This is a guy who specializes in first lien HELOCs, and I believe they're the only banking institution in the entire country that offers this particular product and specialize in it as well. So you're hearing it right from the person, the guy, the company who specializes in it, and you're going to see how it's possible for you to be able to do it. My man, Anthony Rushing, what's going on, my man?
Hey Jamel, I'm great, man, dude. Thanks for having me on. I'm excited to chat with you and kind of share, what we've learned, what we know about this particular product. How people are using it, right, and how people are using it to improve their lives. One of the ways is to aggressively pay off their home,
Yeah.
and it's amazing. It almost comes across as being kind of magical or fake. People kind of push it off, but the reality is the results that we see and the results that our clients are getting are true, and we see it day in and day out, and it's amazing. I'm kind of grateful to have kind of fallen into it, if that makes sense, because it's something where I feel like my work day in day out gets to actually improve people's lives in a way that I don't know if I'd be able to otherwise. So it's really pretty cool.
Absolutely, man. So we're here to provide the value, man. We're here to provide the game plan, the information that people need in order to be able to take advantage of this stuff. Because honestly, this stuff is it's not readily available. It's just not, right? You know, the
Right,
banking, the honestly, a lot of banks, the banking society, so to speak, they don't want us to know this stuff. They want to keep us on a 30-year mortgage for as long as
right.
possible. But at the same time, this particular product isn't for everybody. It's not going to work for everybody.
So,
So
so
we're here to provide that information that people need in order to make that determination for themselves, right? So
absolutely.
why don't we tell everybody a little bit about yourself, bro?
Well, I have my history, a bunch of different things. Finished high school, went to college, and joined a band. I left college to join a band. I played music for 6 years, toured and did all that. Got my real estate license at that point, and then toward the tail end of my time with the band. Met a real estate investor. I had my real estate license at that point, and we created a three-person partnership, and we built up 40 doors, which owned and managed, and then actually when I went back to college, finished college, and then went into to teaching. Actually, I went and joined this program called Teach for America that focuses on extremely high educational outcomes for underprivileged kids, if that makes sense. And that really was a calling for me because I knew that my work and my toil, and sweat and tears and everything, right, was actually it resulted in someone else's benefit, right?
Hmm.
And I felt like that was a really worthy cause. Went to school for that, was going to become a principal, all that kind of stuff. Had twins. And then realized that so through that we ended up selling the complex, if that makes sense, and that gave me the down payment to buy my primary residence with my wife at that point. So but we when we had twins, I realized and thought about the likelihood of me providing a financial feature for them in the way that I wanted, and it was hard for me to see that, right? And so made a move into the mortgage business, which is complete 180, right? And that was really a decision for the family that I made. And I did the retail stuff and then found out about this first lien HELOC product. And I learned about how it how people are using it to aggressively pay off their homes, become debt free. People are using it, the capital in their home or the equity in their homes as capital to invest and leverage for investments to build, to build wealth, to build generational wealth. And I also learned that no one knows about it. And I was like, this is crazy. How can no one know about this? And I was, it's something that provides an extreme amount of value, right? When it works. And it's important to say that. But when it works, it provides an extreme amount of value. And I thought, I was like, through education and through my work with that, you build a skill set to be able to teach concepts to people, right? You understand in a way how to present information and build upon foundational understanding to get to higher level concepts. So I was like, man,
Hmm.
this is great. I get to now go back to something where I'm not just doing this for financial gain for my family, right? I get to have a purpose that does that, but also is for a higher purpose in a way. And to me, that's what drives me as a person. And so I was really attracted to this, and I was like, look, I'm just gonna commit everything to that. So that was about 4.5 years ago at this point, and I made the complete switch from retail, amortized mortgages to this, and that's how I got here. And I am extreme. I love it. I'm extremely passionate about it. The people that we're able to help have been able to change their life trajectory in a lot of ways, just because with what they're doing already, we apply a financial vehicle for them that just works for what they're already doing better, right? And
Absolutely.
it's not a given for everybody, but like that's really what we try and do. And when it works, it can be life changing. It's awesome.
Yeah, man. So great story, man. We heard how you got into real estate. We also heard how you got into the mortgage industry and why first lien HELOCs, why you're passionate about it. So what exactly is a first lien HELOC?
Yeah, that's a good question. So, um, all in all, a first lien HELOC is just a different kind of mortgage. It's a mortgage. It follows different rules than an amortized mortgage does. That's it, right? So people hear HELOC, a lot of times they think of a second lien HELOC, and that's an extension of credit on top of your existing mortgage, and that hence the second lien position. It's kind of on top of your mortgage. They get paid off second if the borrower defaults, right? That's
Hmm.
a first lien HELOC is the actual mortgage. And so a lot of times what we'll do is use it as a refinance, right?
Hmm.
So we'll refinance people out of their current mortgage by using a first lien HELOC to pay off their mortgage. The first lien HELOC has a limit, we call it the line amount, right? And it has a balance, which is usually the balance of your current mortgage. And it's an open-ended line of credit. So, we're talking, it's a mortgage that just follows different rules than an amortized mortgage does. The main rules have to do with money flow and has to do with interest calculation. And what we do, is we basically teach people how to work within those rules, how to
Hmm.
leverage those parameters, right? How to best take advantage of how this loan works for your advantage. And that's really all it is. A lot of people think it's some um, new crazy idea, and it's actually been around since before the amortized mortgage as we know it has been around.
Yeah.
A lot of people think no one else uses it. The reality is this is the main type of home loan that people use in Australia, South
Hmm.
Africa, across Europe. It's another type of home loan that people use when it makes the most sense. And that's really all we're trying to do is bring it and advocate for this product that may actually be better for you.
Hmm.
Um, if it is, then it makes sense to choose it. If it isn't the best option, then obviously you shouldn't get it. So really that's what we're here to do is just kind of share and advocate for this whole product and concept and way of using it.
Absolutely. And for those of you who are interested, keep watching because we're gonna share with you how you can get a consultation with Anthony in order to be able to see if this is the right fit for you. Now, also as a side note, I know we're throwing around the term HELOC. A lot of people may not understand what HELOC means. It's basically a home equity line of credit. You want to talk about that a little bit?
Sure, sure. So home equity line of credit. I don't like to compare this to credit cards often because credit cards have a bad rap, right? Or they can have a bad rap. A credit card is a line of credit. And the thing that makes it a line of credit is the institution, bank, whoever it is, provides you with access to their money, we'll call it, right? And you can borrow against that line of credit and you can pay it back if you want. Money can go in and money can go out freely. So what a home equity line of credit is, it's a line of credit that's actually secured by your real estate. And that's why I call it's a kind of mortgage, right? Because a mortgage, by definition, is a loan that's secured by real estate. And so a HELOC is a kind of mortgage, right? That's an open-ended line of credit, which means you can put money into it, you can pay it down as much as you want. But every dollar you put in there, you can also take back out.
That's
When you
right.
take it back out, it increases your balance too, right? So, so I like to compare it to a credit card because that's something that people are familiar with, right? And so it works in a similar fashion, right? So when you get a first lien HELOC, it pays off your mortgage. You have a limit, just like with a credit card, right?
Hmm.
And you have your balance, just like with a credit card, and you pay interest on that balance. Now, the way it calculates its interest is different than a credit card, but in that respect, it's the same, right? It is a line of credit that you can pull from and use it as you need, but you can also put as much money into it safely. You can put everything into it safely if you want, right? Because because every dollar you put in there, you can take back out if you need it. So the liquidity piece is something that, and when I say liquidity, is access to the money you put into it, right? The money you put in, you can take back out, so your money is liquid. That part of it is actually an extremely integral piece or understanding for people to get to be able to use the strategy, right? To be able to leverage how this works, right? So,
Yeah, man. So let me ask you this, man. And this is just, a question that, I'm randomly coming up with because I'm sure a lot of people are going to ask this question as well. How
yeah.
can people use a first lien HELOC to pay off the balance of their property relatively quickly?
So there's a strategy, right? There, again, I kind of go back to what I mentioned before. With any structure, vehicle, any sort of financial vehicle that you have, there's a structure to it, right?
Hmm.
And the better you understand that structure, the better you know how to work within it to take advantage of how it works, right?
Hmm.
So that's what we do. So there's a certain way to treat, I'll call it, right, a first lien HELOC to fully maximize its benefit, right? Some people call it velocity banking, right? We've our thumbprint is maximize cash flow strategy. Someone else calls it accelerated banking, right? All these terms, and if you look up velocity banking, that'll be the one that probably pops up the most on the internet. That's the one that's most familiar. But all that is there's a best way to work within this loan, right,
Hmm.
to get the maximum benefit. So we teach that, right? People utilize the strategy. So we talked about one difference which has to do with the money being able to go in and come out, right? That's extreme. People, we use that, right? The other way it's different, and the reason why I'm going there first before just going straight to the question is because, and this is the educator in me, right? Is that in order to understand how we use this, we have to understand how it works first,
Right.
right? So there are two main ways. One has to do with money flow, and the other one has to do with interest calculation. So on the interest calculation part, if we compare this to your mortgage, right, the way your amortized mortgage calculates its interest each month is it looks at your previous month's end balance and it uses that end balance against your rate to calculate your payment for the month. And that's just how they work, right? Nothing wrong with it. It's just the calculation that they've chosen to use.
Hmm.
a first lien HELOC or the right first lien HELOC is going to use a different calculation. It's going to use what's called the average daily principal balance. So what it does is it takes the average of all the days in the month, right? So you've got, let's say 30 days in this month. It takes the average of all those individual days balances. It uses that average against your rate to calculate your payment, right? Well, that means if you want the lowest payment, you need to create the lowest average, right? That understanding, right? If we want the lowest payment, we create the lowest average, right? Well, how do we create the lowest average? Well, if I've got 30 days in the month, right? I want the lowest average for all those days. I need to have the most number of those days with the lowest balance. Does that make sense? Right? I need the most days out of all that with the lowest balance. That's kind of the big secret, like a big reveal, like here's the curtain, right? So that means we need to start with the first day with the lowest balance, right? So if we're going to maximize how this works, we need to create the lowest balance on the first day possible, right? Because that takes advantage of how this works. That leads into the first part of the strategy, right? So if I'm going to create the lowest balance as fast as possible, when I receive money, all of that money needs to go into the first lien HELOC because that creates the lowest balance as fast as possible, right? So when you get paid, when people implement this strategy, when they get paid, they deposit the money not into their checking account, but into the first lien HELOC because that creates the greatest decrease in their balance. And every dollar they put in there goes toward principal, pays down the balance. It's like your principal payment almost, right?
Like you're living off your house, pretty
You're
much.
living off your house. That's right. Well, if you did that with a mortgage, an amortized mortgage, remember, amortized mortgages, your money's locked away. It's called the closed-ended loan. And so if you put all your money in your amortized mortgage, well, people need to eat food and pay for stuff, right? So you can't get the money out to pay for your
Right.
expenses, which is why that is not possible. Well, not a good idea for an amortized mortgage. Well, remember here, everything you put into it, you can take back out. So that's just what you do. You pull from this to pay your bills, right? You pull from this to pay your cell phone, your car, your Hulu subscriptions, right? Your kids' education, if that's what you're doing, right? Every expense that you have comes from there. So if we think about the month as a whole, all of your money goes in, which creates the greatest decrease in your principal balance. Well, as you pull from this to pay for your bills, your balance incrementally increases month over month. And at the end of the month, take a look and see where's my balance now compared to the beginning, right? So basically what it means is every dollar from your income that you put in there that you don't take out to spend, right, is simply still in there. When you first put it in there, it's principal reduction. You take away from that, and whatever's left in there is your principal pay down for that month. And so what that means is that it allows for you to use every dollar of your surplus and dedicate that toward paying down your house. Every single dollar that you don't spend is dedicated toward principal reduction, which means there's no faster way to pay off your house.
Right.
Because there's no money anywhere else. All of your money is there. You just take money out to pay your
So, you-
bills.
so you're literally dumping your entire paycheck. Let's say somebody makes, I don't know, $5,000 a month, and this is after taxes, and they're trying to pay off a $200,000 house. Literally, the $5,000 is going toward the payment, and then they'll pull the expenses that they need to live off of from that amount, almost like a credit card, like you mentioned.
Almost, yeah, almost like a credit card. I mean, it's because both are open-ended lines of credit, we can compare the two because they work similar. This just works in a much grander way, right? In a much bigger way because you're not talking about a $10,000 payoff, right? You're
Right.
talking about a $300,000-$400,000 payoff. And oh, sorry, go ahead. Yeah,
So I was gonna say, if somebody keeps pulling money because you got to live, right?
you gotta
So
live.
if somebody is paying off their mortgage, but then they continue to pull money from it, wouldn't that affect the balance at the end of the day?
100%. 100%.
So they
But
would, although they are paying, so they're meeting their monthly payment amount, but then they're still pulling some money out, which means that they have to pay more money back as well, doesn't it?
um, Yes. So, if there is if we think about your scenario, you owe $200,000 in the house and you deposit 5,000 into it.
Hmm.
That income of that $5,000 does reduce the balance from 200 to 195, right?
Hmm.
Which that's a $5,000 reduction in your balance, right? You paid down your house by 5,000 bucks, right?
Now let's say they use 3,000 of that again, so it goes back up to 198.
That's right. It goes back up to 198.
Got it.
So out of the $5,000 that they put in there, right? They took out 3,000 for their expenses. Well, they
Hmm.
still have $2,000 of principal reduction, right? Because the income goes in as principal reduction. They still have $2,000 of principal reduction in there at the end of the month. That's
Which
kind of
is
the way I like to think about it.
which is great because with the banks, like using that same scenario, if I were to put $5,000 towards, let's say I needed to pay off a $200,000 note,
Yep.
and I put 5,000 toward it, but I have no other way to pay my other bills and anything like that. I can't reuse that money unless I refinance, which is going to cost me money,
That's right.
right?
That's right.
And then on top of that, using that same scenario, if I make a, let's say, a normal mortgage payment on a regular loan to a bank,
Hmm.
only a fraction of that amount is being paid towards principal.
Right.
Majority of that, especially in the beginning of a loan, is being paid towards interest. So
Right.
I'm not really paying down that loan for, I think it's like an average of 17 years when it flip flops, and then you start paying more towards the principal than the interest. You know what I mean? So,
I do. I
um,
do. And that's a path that we'll probably want to go down a different day
yeah.
because the amortization schedule is something um, that people I think just accept because
Hmm.
they're like, hey, look, this is the way to become a homeowner. Yeah,
Yeah.
it kind of stinks, but I'm just going to ignore how bad the schedule is actually. How bad
Yeah.
amortization is for me. I'm going to ignore it because that's just how people become homeowners. I can go on a soapbox for that for a long time. So we'll save that for another day. But yeah, I agree. I agree.
Yeah, so if you guys want to see another podcast episode with Anthony where we talk about the ins and outs of the amortization schedule and how it's really not that effective, be sure to leave a comment in the comment section if you're watching this on YouTube,
Yeah, that'd be great.
or hit the like button as well while you're watching this video. But listen, um, another question for you, man.
Yeah.
We're here to learn how to pay off a mortgage in 5 to 7 years. All right, a lot of people want to know how to do that.
Yep.
Why don't we provide them with let's say a 5-step process on what it takes to be able to use a first lien HELOC to pay off their mortgage within a 5-year time frame?
Yep. The first thing that has to be true is you have to budget well and you have to make more than you spend.
Mm,
That is the it, I could even bring it down to a one-step process. Well, not process, but that's the prerequisite, right? You have to be able to budget. If
hmm.
if you're living month to month, right? Let's use that scenario, right? Um, Household owes 200,000 and they bring in 5,000 a month. That's great, right? So they drive in their income, reduces their balance from 200,000 to 195, right?
Hmm.
Well, let's say they have two kids in daycare and two car payments, and they're and they go out to eat sometime, right? But their expenses are 5,000 too, right?
Hmm.
Well, remember when they drive in their income, that reduces their balance on the first day they can, and that affects their average daily principal balance. That's awesome. That's a win, right? Because you're saving money on interest. That does work, and that is the best way to treat this, but that won't make this work, right? Because in this scenario, their expenses are $5,000 too, right? We're living month to month, right?
Hmm.
So they pull from their HELOC to pay their bills. Well, their balance at this point is 195. As they pull from their HELOC to pay their bills at the end of the month, they've pulled out 5 grand. So now their balance is right back to 200,000.
Hmm.
Next month, 5,000 in down to 195, right? They pull from their HELOC back up to 200,000, right? 195, 200,000, 185. This household would never pay off their home with this, right?
Hmm.
This is not a good idea for them, right? It isn't often, but every once in a while, we'll talk with people who are excited about the strategy and the idea. They learn about this and they're excited it's going to work for them. And we run a calculator every time we talk with people. But every once in a while we'll come across someone who thinks it's going to work, and we have to, our goal is to help people with this, right?
That's right.
Not just to get loans. And
Hmm.
so our goal is to change people's lives for the better. And so if we know this isn't going to work, hey, look, do these numbers look good to you? Well, no, they don't. That's weird. Well,
Hmm.
here's the thing. It looks like there's enough cash flow in the household for this to work, right? But so number one is you got to make more than you spend. You got to budget well. Got to be disciplined with your finances.
What if people wanted to make some sacrifices, right? Let's say somebody makes 5 grand a month
Hmm.
and they're, spending a little, they're eating out a little bit more than they should, but their goal is to pay off the mortgage in 5 years. You can sacrifice some things in that case, right?
You can sacrifice some things. We
Or make more money.
or make more money, or if you have a car, well, there's this other part to it too, where this is a great debt consolidation tool
Hmm.
also. So if
Yep.
you have two car payments and you loop them into the HELOC, it actually increases cash flow more than it hurts you from a HELOC payment standpoint, which we can go over that later too. But that's a really good way to shift debt from a
Yeah.
less a bad place per se, right, to a much better place, which can actually change the trajectory for this as well. You can change your habits, and you can choose to eat out less, or you can choose to spend
But
less on.
what's the reality of that actually happening? Most people
That's
don't
the
want to,
thing, right?
most people don't want to change their habits, right?
And that's
So,
the way. That's kind of the direction I was going. Is like, yes, you could, right? We don't like to have those types of conversations, or I don't like to guide people there
hmm,
because I believe that one of the hardest things to change is your routine, is your habit, culture, whatever you want to call it, right? Like
hmm,
that's why people like, your Dave Ramsey's are doing a good job, is because they are able to successfully help people become disciplined, right?
right.
That's really hard.
Hmm.
I mean, most of the people who were not disciplined before and now they are, the reason why they did that is they had some major event in their life that snapped them out of it, and they said, I never want to go there again.
It's
Right?
like, what that's like, man. What's coming to mind. It's like asking somebody to lose weight when they really don't want to lose weight. You're telling them to
That's
change
it.
their diet.
Or they want to lose weight,
Yeah.
even if
Or
they
they
want
want to.
to.
Yeah. Maybe they
Right?
do
Or
want to
hey,
lose weight.
look,
You're
I
asking
want
them to
to
change up their diet. Do they really want to lose the weight?
yeah,
No.
like I want to go to the gym and get your shoulders. That's not going to happen.
Yeah.
Like come on, like what I'm saying, like, but that's the thing is like even if people, it's not like we're forcing people to make the change. People
All right.
want to make the change, but
Mm-hmm.
just like diet programs, just like workout regimens, just like what New Year's resolutions, right?
Hmm. Yep.
I'm going to do the 5 o'clock morning thing, right? Like
For three
people,
weeks.
the three, I'm going to do for 3 weeks, exactly, right? And then what happens is you go back to your
Hmm.
regular routine.
Habits. Yep.
That is also something that we pay attention to, right?
Absolutely.
Because I could have conversations with people all day and, hey, look, why don't we just say, like, do you think you can cut out on this? Those aren't conversations we have
Right.
because we want to set people up for success.
So
Um,
first things first, you're approaching this from a realistic standpoint. You don't want to put somebody in a position where they're going to fail right off the rip, right?
that's
So
right.
you want them to be able to succeed at this, which is make more money than you spend. That's step number one. What would be step number two?
Step number two is I would either watch Jamel's podcast, a little shout out there, about velocity banking. You can go to firstlienheloc.com as well, and they have
Mhm.
it's a free educational resource that you can learn about this. There are other really great resources online
Mhm.
in terms of not to push people in a different direction, but online if you look up velocity banking,
Mhm.
we believe that we don't want just to tell you it's going to work, right? The conversations we have with people are not, hey, give me tell me how much you owe, what are your expenses? You're going to pay off your home in this amount of time, right? we could do that, but we're not empowering people to understand how this works and to control it. Because
Hmm.
the reality is that you have control over how fast you pay off the house, but it's not going to work if you don't understand it. So we believe in the power of education,
Education.
um, and that was again that was one of the main alignment uh, pieces that I recognized in terms of this product and what comes
Hmm.
with it. The fact that this strategy is not as well known, the fact that the product is
Hmm.
not as well known, right? That involves a lot of education. The fact that people are actually paying off their homes in 3 years, 5 years,
Hmm.
7 years, that people are really skeptical about it
Yeah.
because they're like, that's got to be fake, right? It's got to be fake,
You
right?
gotta
There's
you gotta
no
see
way,
other people doing it. You need
right?
testimonials, right?
And I've never
Yeah.
heard of this thing before.
Yeah.
So yeah, it's got to be fake. Well, the reality is that it isn't fake. We do see results like that day in, day out, but it does take
Discipline.
understanding about how do you control this, right? So if things go awry, right? Or if things, it's a flexible tool. So if things go out of the way that you expect them to, you know what to change, you know what to do to control this to go in the direction that you want, right?
Yeah. So first things first, look, be disciplined, right? So you need discipline
Yep.
in order to spend less than what you actually make. A lot of
Yep.
people have that problem, so it's not easy.
Yep.
So you heard Anthony say, look, other countries use this tool. You have Australia, they're using it. Certain parts of the UK using it. Other countries are using this as a primary tool because it actually works.
Right.
Right? This is how they're building real wealth relatively quickly. In America, we're so uh, I don't want to use the word brainwashed to
Conditioned.
use. We're conditioned. That's a better word to use. Conditioned to use the 30-year amortization loan,
Right.
and we believe in that because of that because that's what's being positioned in front of us. But if the first lien HELOC was positioned in front of us, we'll believe that that actually works as well. We'll see results because everybody around us isn't using the first lien HELOC. A lot of us are uneducated on it, and
Right.
that's where the education part comes into play. So you got be disciplined,
Yep.
get educated,
Yep.
right? These are the first two steps. What would be step number three?
Step number three. So we have a calculator on firstandheloc.com that you can actually input your numbers, right? You input the amount that you owe on the house. You input your current take-home pay, right? Because that's the amount of money that goes into the HELOC each month, right?
Mm-hmm.
You input your monthly expenses. Those are the most important parts, right? Expenses are everything you spend money on, right?
Mm-hmm.
Your mortgage isn't
Including business. Let's say somebody owns a business.
Hmm, that's a great question.
Should they include that in there as well?
It depends on if you're using gross business income
Mm-hmm.
or if you're just using your household take-home pay.
Mm-hmm.
If you're using your household take-home pay in terms of your distributions, or if you do distributions with W-2, right?
Mm-hmm.
Then I would just do that, and then I would just do your household income if you plan on keeping them separate. If you plan on integrating them, it for one, you're going to want to talk with a CPA, tax
Mm-hmm.
attorney about intermingling of funds and how to show it in a way that you can present to the IRS that they're going to be okay with, right?
Mm-hmm.
Um, if you're going to include gross business income, then you're going to want to use business expenses and and household expenses as well.
Right.
So usually we do household expenses because there have been a handful of people who've successfully integrated the two, business with first lien HELOC. The reality is the first lien HELOC is written to your person or to a revocable trust. So there are ways for tax attorneys and CPAs to integrate the two, uh, but and I'm happy to share those later on. But my advice is if you're going to try and do that, then first consult with them because they're the ones who are going to have to get your back if the IRS comes after you. So
Mm-hmm.
it needs to be their plan. They need to be the ones who manage, who come up with the plan and manage it and understand it. So that way they can explain how it's legitimate within the tax code. So,
Got it.
but it's a good question. It is. So yeah, if we usually go with personal, take home pay.
Mm-hmm.
Uh, and then household expenses as well, and the leave the other stuff aside, if that makes sense.
Got it, man. So, at the end of the day, we want to use that calculator to see if it's a good fit for us. I'm going to be sure to link the uh, the link in the description box that you guys need in order to be able to get access to that.
Definitely.
So, first three steps, we talked about three of them, right? Discipline, right? Spend less than what you make.
Yep.
Number two, educate yourself.
Hmm.
You're already doing that right here. And I have a complete infinite banking and HELOC playlist on my YouTube channel where you can get more information. In fact, I'll link the podcast I just did with DeAndre about how HELOCs actually work right up at the top so you guys can check that out. And number three, you want to use that calculator. Start playing around
Definitely.
with the numbers to see if it's a good fit for you.
Yep.
What would be steps number 4 and 5? How is it possible for our
Yeah.
listeners to uh, pay off their mortgage in 5 to 7 years?
So step four would be schedule a call with one of us. I my official employment is actually with First Savings Bank.
Hmm.
I'm a loan officer. I was the sole loan officer for a couple of years, just doing first lien HELOCs. We have we've grown a good bit in terms of volume and presence, and so now we've got four loan officers here. I'm the sales manager helping drive the team,
Hmm.
and so schedule a call. I can give you the link for that too. You can check that out with one of us. And what we'll do is we'll actually walk through the education piece with you.
Hmm.
I don't want to say we force that, but we kind of force it because it's that important.
That's a good thing, though, man.
Yeah.
That way people understand exactly what they're getting themselves into
Yep.
when I hate to say getting yourself into it because it sounds like it's coming from a negative standpoint, but really it's not. You're
Right.
educating yourself to know exactly what you're doing to be successful at it. That's probably a better way to position
A
that
100%.
phrase.
A hundred
You know what I
percent.
mean? So schedule to consult with you guys. You guys will walk them through it, almost like coaching them through it in
Yep.
order to be successful at it, right?
100%.
And I'll link that in the description box for you guys. And finally, step number 5. What would that be?
Number five is fill out the app and get the loan.
Boom.
The experience looks just like a mortgage. Whether it's a refinance, we can do these for purchases too. So, it requires 10% down as well. So we can go to 89.9, roughly 90% loan to value. So if you're doing it as a purchase, it's 10% down. Most of the people that we help are doing a refinance
Hmm.
because as they're doing research, they get frustrated with the fact that amortized mortgages work the way that they do,
Hmm.
and they look for different alternatives that can work better, and this is one. And so yeah, the last one is fill out the application
Take
after the
action.
call. Yeah, after the call that we have, we'll say, hey, look, is this something? As long as the numbers work, right?
Yeah,
Is this something you can
absolutely.
move forward with? Send you the application, and then it just really looks like kind of getting pre-approved, and then underwriting, and then you get the loan.
That's right. So if you're purchasing a property, normally if you're going through with a 30-year amortization, you can get an FHA, you can get a conventional loan for
Yep.
less than what you have to put down here, right? 3.5 to
You can.
5%.
You
But
can.
here's the deal. You got to sit on that loan for 30 years and you're going to probably pay 2.5 times of what the actual purchase price of that mortgage is. So if you're buying a $200,000 home, you're going to end up paying $450,000.
And that's the best case scenario, Jamel.
Yep. Best case.
That's if you don't refinance. That's if you
Yep.
don't move to another home. I
Yep.
mean, we're talking,
Most people stay in their house for 5 years.
right?
You
So
know
we're
what I mean?
talking 7 to 8 different amortized mortgages that start at the beginning every
Hmm.
time. And we could talk more about that later, but like
Yeah,
that's a big deal.
yeah, absolutely. Versus coming up with another 5%, 10% down on a purchase and being able to pay off this property in 5 to 7 years.
Yep.
That's what we're talking. That's how you build real wealth. That's how
That's
you
right.
get access to the capital you need, right?
That's right.
Or you can go to refi process. The rather than if you have the equity in your home,
Yep.
let's say your house is worth $200,000, they'll give you 180,000,
Yep.
and you won't have to come out of your pocket with that 10%.
That's right.
Right? The 10% is already built into the home. What if
That's
you have
right.
investment properties? Would this work on investment properties as well?
So I can't do first lien HELOCs on investment properties right now.
Hmm.
Um, between you and me, and I guess everyone else that's watching the podcast, we're working toward that, but I can't do it right now.
Perfect. It's
That being
something that you're
said,
building on.
yeah, there you go, there you go. That being said, there is a really great strategy
Mm-hmm.
to not just pay off your home, your primary residence. There's a way to utilize this with multiple properties to become debt free from a portfolio standpoint with just one. And so we can talk about that too. It's a really cool strategy. I think it's cool. I'm kind of biased, right? But but
Let's
it
dig into it. Let's dig into it a little bit, man.
okay. So we have this way of aggressively paying down your debt, right? All your money goes in the HELOC. You pull from the HELOC to pay your bills, and all your cash flow serves as your principal reduction, right? And the more that you cash flow, the faster you pay down debt, right?
Mm-hmm.
And if you just pay off your house, awesome, right? Well, let's say you've got three other rental homes with mortgages on those. Well, now you're stuck paying amortized mortgages on these other homes.
Mm-hmm.
So the strategy that we implement, which is actually better than if you had HELOCs everywhere. So, and I say that because what people I think initially think is from a debt pay down perspective, it's better to have HELOCs everywhere because HELOCs are better. Once they
Mm-hmm.
learn that first thing HELOCs are better, they're like, we got to get them everywhere, right?
Mm-hmm.
That isn't actually true. Numerically, it's better to have one HELOC as your central hub and keep your amortized mortgages elsewhere.
Mm.
Because what you do is let's say, um, let's use that 200,000. Let's say you owe 200,000 on your dollars on your house, but your line amount is 300. Are you
Mm-hmm.
with me? So what that means is you owe 200,000, but your limit on this HELOC on this line of credit is 300,000. So at that point, you have $100,000 that you could access if you want, right? Now we can label that a number of different ways, right? We can label that as your emergency fund. At its core, at its most basic level, that's what it is. We can use that as a tracker to
Mm-hmm.
figure out how is your success with the first lien HELOC? How much equity are you building, right? We can label it as capital, and that's where the investor comes in, right? At this point in time, the investor would label that as $100,000 of capital that I can access immediately at like 8%, right?
Mm.
Which, I mean, the better the investor, the better that they have access to capital in different ways. This is
Mm-hmm.
another way, right? But $100,000 at 8% immediately is pretty darn good in comparison to the other things that are available, right? And so the strategy is to pay down the first lien HELOC to where you have enough equity available to fully pay off one of the other
One of
mortgages,
the other mortgages, and
right?
then you use you keep paying towards the HELOC.
You keep paying, you keep the heat.
Got
But
it.
here's the thing: when you pay off, you don't just pay down the mortgage, right? Because if you just pay down the mortgage, what you do is you take on debt on the HELOC, which increases your interest cost on the HELOC,
Mm-hmm.
but you don't increase cash flow.
Mm-hmm.
You have to fully pay it off. Because when you fully pay it off, yes, you increase your HELOC's balance compared to where it was before, but you increase cash flow because now you don't have a principal and interest payment
Right.
anymore over here. That money flows into the HELOC and increases the pace by which you pay it down,
Man, that
right?
clutches right there,
And you
man.
do it again, right? You pay it down to where you can fully pay off the next property, right?
What's the average turnaround time for something like that? Like, how long would it take? Using this scenario, somebody's paying off 3 rental properties. What do you like? Would that take another 15 years, or like how long does it take to pay off
I mean, it
like that?
just like the first lien HELOC scenario is dependent, your outcome is solely dependent on your cash flow. If that's all we're looking at,
Mm-hmm. Mm-hmm.
the outcome for your payoff time is solely dependent on the balance that you have, the monthly payment, how much cash flow or do you increase each time that you loop in a property.
Yeah.
It's individual to the person, but so one example I had. Probably about a year ago, and this one sticks out. The good ones stick out, the
Mm-hmm.
ones that are super, super solid stick out. But about a year ago, I had a lady, and she had principal residence that if she just paid off, if she just used Velocity Banking to pay off her home, it would take about 5 years.
Mm-hmm.
But she had two other rental properties. One had 28 and the other one had 25 years left on the amortization schedule, right? So by implementing the strategy, she was able to become holistically portfolio debt free in 8.5 years instead. So it added 3.5 years to her payoff
Wow.
time, right? Which completely changed her whole perspective, right?
Hmm.
So her whole portfolio, instead of having an additional 23 and additional 20 years left on her amortized mortgages, she's completely debt free just by looping in the debt from the other properties
Hmm.
to this place. You're shifting debt from a
That's it.
worse place to a better place.
Yep.
That's really all you're doing.
So what if debt free is not the goal though, man? Like what else? How else can you use a program like this? How like what else can you use this money for?
Right, which sounds crazy, right? Like to most people, they're like, why would I not want to be debt free, right?
Hmm.
Well, that's not always part of people's plan,
Hmm.
right? That's like there are a lot of people who leverage debt, right? They use debt. The way we see it
Real
is
estate investors.
investors, we'll name it, right? And the thing is, the way that we see it is this product is flexible to help work with different paths, different goals, right?
Hmm.
If all you want to do is become debt free, I didn't even put that the right way because not all you want to do. If that's your goal, that is an awesome goal, and this can help you do it when it works, right? If your goal is to build a portfolio, to start building a portfolio, to build upon what you already have, to scale, to work toward,
Hmm.
to wealth or generational wealth, this is a tool that can help enhance that, right? So from an investor standpoint, the reality is that it provides you with access to capital that you wouldn't have otherwise with a mortgage, right?
Absolutely.
And there are a lot of people across the country who are sitting on one, two, three, four, five, $6 million worth of equity that is unused in their home that they can't access. We call that debt equity, right? You can't
Hmm.
touch it, right? And that's just part of a mortgage. A lot of people just take that for granted and they're like, okay, whatever, right?
Yeah.
Well, as an investor, the better you are at identifying opportunity that can generate a higher rate of return, right? The more your problem is capital,
Hmm.
right? Hey, look, I mean, if I've talked with a number of enough people to know that the one thing that they say is if I could just have $15 million of leverageable capital, right? That's all, like, there isn't enough capital I could have,
Hmm.
right? Because they're great at identifying opportunity. And so what this does is this frees up, it makes available the equity that you have in your home to leverage, right? So, people that if people strictly want to pay off their home, we'll go to the, baseline, right? If that's their goal and they become completely debt free, now they're sitting on $300,000 of equity that they could use at 8%, 8.5%, which means their cogs can actually start to turn and think to themselves, hey, what if I took $100,000, right? And what if
Hmm.
I took that and bought an investment property and then put $30,000 into it to rehab it, right? And then either did the Burr method and I, refinanced out, did cash out refinance, pay myself back, right? Now I've got this home, right? That's cash flowing, right? Just by doing that. Or what if I were to sell it, right? Which then could generate an additional, if you did a good job,
Yeah.
30 to 60 grand, right? Like it, for one, when you have an amortized mortgage, the reality is when it's paid to zero or even while you're paying it, you have access to none of the equity that's in the home.
Hmm.
This flips the switch, it changes the game, and it gives people access who otherwise wouldn't have had it at all, right? Access to it. For the actual investor, it gives you another source of capital, right? That's immediate, that you can access immediately at an interest rate that is,
And and to be honest with you, man, for me, like I'm going the BlackRock route, man. Like
yeah,
never sell. You know what I mean? What's the point in selling when you can just keep recycling the money,
that's
keep
right.
pulling it out, and keep getting more of it? You know what
That's
I
right.
mean? Get more properties. Use
Right.
that money from the. You know what I mean? So that's the BlackRock route. That's what I call it, at
I
least.
like
And,
it.
and
Yeah,
that's
it's
kind of
cool.
the game you want to play, man.
That's right.
Hold on to assets because you make money when you buy. When you sell it, you lose all of the income that's coming in from it.
That's
So
right. That's right.
the name of the game is like Monopoly, man. You want to You want to make sure you're holding. That's the nature of this whole real estate game in the first place. Yes, there's a lot of different ways to make money in real estate,
Right.
but the real wealth is built through holding real
Agreed.
estate, man. So
100%.
with that being said, man, what are some of the obstacles that people will face trying to get this type of machine going?
Well, once we get the cash flow part, once we get the budget piece out of the way, right? Because that's the main thing, right? I
Hmm.
mean, all in all, that's the main thing. Because that determines your success, that determines your failure. If people, if you have a consistent habit of being disciplined, you're likely to succeed with this. I mean,
Hmm.
that's pretty much it, right? But then there's the part about getting the loan, right?
Hmm.
You have to qualify, right? You have to qualify for the loan.
So what does that look like?
So credit score, you're going to want to have a 680 or above. 700 is sort of the mark that provides the best terms.
Hmm.
The interest rate isn't, at least for where we are, right, at First Savings Bank, the interest rate isn't dependent on the score.
Hmm.
So as long as you qualify, same options. And so there's the credit score, type of home, right? So I can do stick builds, I can do condos. Um, can't do mobile homes or manufactured, or the other one that starts with an M that I can't remember right now. Mobile manufactured, and there's another one. And I can do all states. We can do all states except for Texas, Hawaii,
So
and
so none of the M's, none of the M
none of the
EM type
M's.
of
None of the
homes.
M's. Yeah.
Got it.
Um, let's see. I can do all states, but Texas, Hawaii, and Alaska right now.
Quick
Uh,
question about the not to cut you off, man. Quick question about the income. Like what type is there a certain income level that someone needs to be at in order to make this happen?
that's a good
There's
question.
there's some people here that's not making a lot of money, but then there's people who are kind of there's all levels of income here.
Right.
So
Right.
what about the people who aren't as making as much because they're a little on the younger side?
So if you if you already have a mortgage on your house, right, and you were able to qualify for that, qualifying for this is uh, a little bit more stringent, if that makes sense from an income standpoint.
Hmm.
But if you qualified for your current house, it's likely that you'll qualify for this too.
Got it.
In terms of new purchases, in terms of purchasing a home, um, I, I I wish I could give you a good answer, Jamel. It's really
I understand.
we can't know until we get it in, and that's kind of a risk people don't always like to take because
Hmm.
it involves a credit pull and stuff.
Right.
But people don't like to take it. But you know, uh, you can go to places like Rocket Mortgage or they're quick pre-approval places where they can tell you you're pre-approved for X in 5 minutes.
You don't
Uh,
always qualify though.
they don't. I don't see that as as doing a good service for the client.
Yeah.
You got to do the work to get a good answer, and like they just don't do the work, and they give you an answer, but it's not a good one. So you can't
Right.
always trust it. So it's better just to do the work and learn either the good news or the bad news, because if you're working with someone good, they'll tell you how to make you know a bad answer a good one, to get it right so you can move forward.
Hmm.
Um, but the debt to income is a piece that balances the amount of income that you bring in against the amount of debt that you currently have, including the projected housing expense, which is the cost of the home, the loan in the future, right? And so our debt to income max is a 45%. That doesn't usually mean much to people, unless you're kind of in the business or you do this a good bit, right?
So if
Um,
somebody's making 10,000 a month and they spend 4,500, that's probably a good window.
that's probably a good window, right? And um, so the debt to income has less to do. So I kind of separate two lines of
Hmm.
thinking,
Hmm.
right? One is the first lien HELOC a good idea for you, right? That's where we talk about your spending, including your, restaurants and your credit cards and, your Hulu subscriptions and all that kind of stuff, right? Then we talk getting qualified for the loan, and our conversation around debt to income is a little different because we don't include your little expenses that you spend in
Hmm.
the debt to income, right?
Hmm.
In terms of getting qualified, that has to do with your credit report.
Hmm.
which includes all liabilities that you have. So your car payments and your student loans and your personal loans and the amount that you owe right now on your credit card bills, right? And those kind of things. But it doesn't include all the other
Mm-hmm.
lifestyle spend, right? And the lifestyle spend, that's the reason why we have that conversation first, because that is determining whether it makes sense for you to even move forward with this idea or not, right? And then we get to qualifying for the loan, which is just a little bit of a different conversation, if that makes
Mm-hmm.
sense. Um, and and so there are ways for us to work within the credit report that we pull, within the debt to income. For instance, we can increase debt to income by looping in a car payment, right?
Mm-hmm.
And that helps from a debt to income standpoint, which also helps from a payoff standpoint too. So it's a win-win.
Mm-hmm.
So even when if we first get in a loan and the debt to income is at 50%, there are things that we can do uh, within the rules of the loan itself to help the debt to income get down, below that 45% that we need.
You need to have enough equity in the house to be able to do that, though. I'm
You
assuming,
do,
right?
right? So
Yeah.
again, we can go to 90%, 89.9% loan
Mm-hmm.
to value. So if you just bought your house and you put 5% down, um, I could only do it if you brought the other 5% to the table, right?
Got you. So, like, let's say, for example, somebody has a house they paid, I don't know, 250 for, and now it's worth 500. But
Okay.
now they got two cars, and those cars are worth, you know, I don't know, 100,000 bucks.
Yep.
They can probably get this loan done because at 500 at 90, so $450,000 minus the what is it, $300,000 in debt that they probably have
Right.
left after paying off the mortgage and stuff. That still leaves them with an extra $150,000.
150,000. So in that scenario, at the very core, the very base, they have $150,000 of cushion, right?
Exactly,
Of emergency fund,
which
right?
is strong, you know.
That's strong. Look, that's a lot. That's a lot of months of not having a job it's one of those things we present it that way where it's like, look, if worst case scenario happens, because people come with these questions, right? What if I lose my
Hmm.
job, right? Well, if you lose your job with a mortgage, you get a 30, 60, 90-day late unless you can come out of pocket to make that payment, right? Here, we call it floating the debt. You fall and you float on the equity on the home. When you do that,
Hmm.
yeah, it pushes your timeline back. Yeah, you increase your balance because you're pulling from this to put food on the table for your family, to cover your bills, to make your interest payment to the bank, right?
You're basically pulling it from the house to pay the house back.
You
That's what you're
are,
doing.
right? Which we don't lead with that, right?
Right,
That's
exactly.
not we if you're worried about losing your house,
You shouldn't do
you
it.
shouldn't do it, right? I mean, but it's a secondary benefit, right? That's
Hmm.
true, right? And so it provides a level of security. So in that scenario, you start with $150,000 of cushion, right? Or if you define it differently, right? I would still keep 40 grand or whatever your 6 month
That was my
number.
point, man. Like me personally, I like to keep a year's worth of income,
There you go.
right?
Yep.
So a year's worth of income in the bank will float you, right?
Right.
Everything on top of that is kind of useless to keep in a bank.
Agreed.
You know what I mean? So like a year's worth of expenses in a bank should even the average person is not doing a year. Let's say 6 months worth of
6 months.
expenses in a
That's fair.
bank, right?
Yep.
6 months would be what, 30, 40,000 bucks for most
Right.
people,
Right. So
right?
let's just say 50, just for easy
So
numbers.
50 grand. So with 50 grand, anything above that should be invested, in
That's
my
right.
opinion.
So in this scenario,
You
right?
won't have to, you won't, in this scenario, you won't have to have that 50 grand in reality because the house is your savings, but we don't want to lead with
Exactly.
that. You know what I mean?
You're exactly right. So in this scenario, right, your balance is 300. You can go up to 450. So you have
Mhm.
150 available, but you're not going to touch the top 50 of it,
Right.
right? So in this scenario, if you're thinking like an investor, you have $100,000 accessible immediately, right? So then the question is, where are you going to put it, right? And that's always a question. What's the margin between what I borrow at and what I receive, right?
Hmm.
And if you're talking about like it depends on the type of investment, right? Sometimes it's a monthly dividend kind of thing, right?
Hmm.
Sometimes it is a longer term, 3, 5, 6, 1 year type investment where you take the money out and that results in an overall additional interest cost, right? That's your cost of funds. We call it cost of funds to you is, whatever the full amount of that cost is, and then what do you generate on the back end after the
Say you're
investment?
doing a flip, for example, like it's going to cost you a good 20 to 25% to do a flip because you borrow. Most people are borrowing hard money, which is, the interest rate
Right.
is crazy. Plus, you're paying interest only on the money while you have it. So you might as well borrow it from yourself at that point.
And hard money takes 10 to 20 days to get anyway.
Yeah, you could do this overnight, literally.
You can. I mean, with a checkbook.
Yeah.
And
I mean,
so,
I would still take precautions just for people who are brand new. I would still follow hard money guidelines, even if you're borrowing money from yourself, because
yes,
there's a reason why they don't lose money.
that's
They're
right.
making sure the value in the property is there up front through an appraisal. They're making sure they have a contractor's estimate up front so they know how much work the property needs. Follow those guidelines. Get the attorney to close the deal or the title company.
Yeah,
Make sure you're still, even if you're borrowing the money from yourself, you want to follow those guidelines because it's a protection for you.
absolutely. But instead of paying
Crazy interest,
crazy interest and maybe a point on the front and a point on the back,
you're paying
right?
to yourself.
You pay it to yourself and you increase the balance for a short period of time. And again, if you're doing a flip, you then sell, you take the principal that you borrowed, put it back in, and all the profit that you received goes back in there too. Suppose that's a $50,000 profit.
Hmm.
Instead, if everything is exactly the same, instead of owing 300,000, you borrow 100,000 up to 400 for the time that you're doing the rehab, right? And then you sell, you get 150 back. You put the 100 back, bringing you back to 300, and then you got the 50 profit that brings it back down to 250, right?
Hmm.
Well, now instead of having access to a total of $200,000 minus the 50, right? Sorry, instead of having access to the 150 that you
Hmm.
had before, now you have access to 200 total minus the 50 that is your emergency fund, your 6 months of living expenses, which means now you can pull 150 out safely instead of 100 out safely. And so people call, when people think about it this way, they call it paycheck parking because what you're doing is you're putting your leverageable assets in a place that works for you while it sits there, right?
Hmm.
And the only time you take it out is if it can work for you better somewhere else, right? And if the only investments you can find are going to generate 5%, then you don't take them out, right? But if the investments that you decide to invest in can generate 14, 20, 30, 50%, then it's a better use of your money because you borrow at a lower rate to receive a higher rate. And it just gives you access to more capital to be able to do that than you'll ever have with a mortgage.
Absolutely, man. And do you need a ton of money saved up in order to do something like this?
You don't need any money saved up,
Mm.
actually. Um, if you're, well, let me take a step back. If your credit score is below 700, yes, you're going to need about 3 months worth of reserves, which is, I would just take your current mortgage payment multiply by three, and that would give you about what you need, right?
Hmm.
You can pull from multiple places for the reserves part of it. Um, you can pull from checking, savings, investment accounts, the brokerage accounts. You can pull from IRAs, 401ks, at least the amount that you have vested currently that you're not obviously borrowing from as well.
Hmm.
So no, you don't need a lot of cash to do this. You don't need any cash, right? If you've got the credit score, then it's just a matter of getting qualified per debt to income and getting it done. Even, there are closing costs. I think it's important to name that. A lot of times people hear the word HELOC, and obviously what we think of are the HELOCs that we're familiar with, which are second lien HELOCs, and those
Hmm.
don't usually have closing costs, so they're super cheap, right? Well, that's just an extension of credit on top
Yeah.
of mortgage, right? Like we talked about before, this is a full refi. And if I think about closing costs are just paying people to do the work, right, to
Hmm.
get it done. So you've got four different entities. You've got bank fees, you've got appraisal, you've got title fees and state fees because banks got to do full underwriting, right? There's a full origination, closing, all that kind of stuff. You've got the appraisal. We do a full appraisal. There's title insurance. Remember, this is a full out mortgage, right? So title insurance and closing fee as well. And then it gets recorded with the state just like a first position mortgage would as well. So, but the great thing is with that is that the only thing you pay for out of pocket is the appraisal, and everything else gets looped into your loans balance. So And that's like $500 or $600 out of pocket. The other amount, again, it gets added to your loan's balance, so it does increase that, um, which is a reality, right? That being said, it doesn't hurt your pocketbook now. So if I think about the, call it pain that people actually receive, really the only pain that people receive if the purpose is to pay off the home is just an additional month or so in terms of their payoff, which really
Right.
doesn't change the outcome that much. So yeah,
So long story short, man, at the end of the day, 700 credit score, right, will get you the best terms on
yep,
this thing.
yep,
You don't really need a lot of money saved up, but if you have a lot of equity, that'll help out.
yep,
And educate yourself on this, man. That's what this is all about.
it is.
And in order for you to get started, I'm going to go ahead and link everything in the description box of this episode so that you guys can look into this and use your money wisely. Smarten up, right? Reach out to Anthony. Let him
Yep,
know what you're interested in doing. If he can help you, great. If he can't help you right away, he'll tell you how you can put yourself in a position in order to be able to get something like this done. I think
yep,
it's a powerful tool. It's not for everybody. So
yep.
you got to be disciplined. Most people are not disciplined. You got to be disciplined. You
Gotta be
got to be
disciplined.
the person willing to go on a diet to lose the weight.
That's right.
You know
That's
what I
right.
mean? You got to be the person willing to go to the gym and put up the weight
That's it.
in order to be able to make it happen. You got to be disciplined. If you're not disciplined with money, do not do this,
That's right.
right? But the links will be in the description box for you guys in order for you to get started. And I'm looking forward to hearing you guys' success stories. Make sure you like this video, subscribe to this channel, click that notification bell as well. Let me know if you want to see another episode with Anthony regarding what we spoke about earlier with the amortization scheduling.
Yep.
I think that's going to be an interesting episode for us to talk about. But Anthony, are there any books or anything like that that our listeners can look into in order to get more information?
Um, it's a good question. Well, in terms of books, I don't specifically know about any particular books that are out there. I do know if you're okay reading through information and trying to, you can go to firstlienheloc.com,
Mm-hmm.
and they've got we have some really, I think, great explanations about what this is, uh, how it works, who it works for. It'll help you better understand how you may be able to apply it to your life and what you're trying to achieve. Um, and I think that would be a really great source to check out, if that makes sense.
Perfect.
Um,
Perfect.
there's a couple books that I could give you that will help you really, really dislike the amortized mortgage. But we can save that for another day too. So
Sounds good. We'll talk about that on the next episode. Again, leave a comment in the comment section. Let me know that you got, because I'm gonna base that episode off of the comments that we receive. If you
great.
guys really want to see that episode, leave a comment in the comment section and tell me. Look, I want to see the next episode with Anthony. We'll make it happen. All right. I'm gonna link Anthony's information, his website, and everything in the description box of this particular episode. If you're looking at it on a mobile phone, you got to play around with with especially on YouTube. You got to play around with the three. I call it the hamburger navigation bar. Right, play around with that a little bit. The three dots that you might see on the screen in order to reach the description. But it's there. You just got to play around with the icons that they show you up on YouTube. YouTube don't necessarily make that easy for you to get access to if you're on mobile phone. Another thing, man. Any last words for our listeners regarding anything
Well,
when it comes to getting started?
I just hope that this has been helpful. Uh, I'm never bashful about advocating or sharing about this, um, because I'll never hold back on the education, on sharing what this is, who it works for, how it works, because the reality is it is another kind of home loan,
Mm-hmm.
and it's a viable option for people across the country. And right now, it's just not very well known, and that's not a problem. But to me, that means that there are a lot of people out there who are missing out on something that could really change their lives. So I don't mind being forward with pushing the idea, because the reality is that whether you get it or not is just solely dependent on the numbers,
Mm-hmm.
right? If the numbers show that it works, then hey, then we have a viable option, right? If the numbers show that it doesn't work, then we say, hey, look, it looks like this doesn't work. So for me, I have no qualms or being, not necessarily being pushy, but like really going out there and sharing this and saying, hey, look, this can be a really great idea because if it doesn't work, you shouldn't get it, and we'll find that out, right?
Right. Absolutely. Listen, guys, we've talked about the good, the bad, and the great and the ugly on today's podcast episode. And when you get the good and the bad, you know you're getting real gems,
That's it.
right? Because if we only talked about the good stuff, then you should be skeptical. But we talked about you not being able to qualify as well, which is the bad part of it, right? So, this was it was a fantastic podcast episode,
Thank
in
you.
my
Yeah.
humblest opinion. And I'm looking forward to having you back. I'm looking forward to continuing to build with you and seeing how we can help as many people as possible go from where they are to where
Yep.
they want to go. And listen, be sure to like this video, subscribe to this channel, click the notification bell, share it with your family and friends. Let's educate people on how
Yeah.
HELOCs actually work because we're conditioned, I like that word again, we're
Yep.
conditioned to believe that an amortized mortgage is the best fit for buying a home, when in reality, you build real wealth using the strategy that we talked about today.
Definitely.
I'm looking forward to hearing from you guys. Leave a comment in the comment section if you want to see the next episode, and we'll see you guys then. Take care.